It looks like we're set up for a lost US decade, and this has important consequences for both US and non-US investors. So in this video, we look at some of the reasons behind US stock underperformance, and we end with some practical ways to avoid its negative effects. Now, don't forget, if you do enjoy our content, please do subscribe to our channel. That way you won't miss any new videos. So let's look at surviving the lost decade in a bit more detail. Vanguard puts out a 10-year forecast for various asset returns. And if you look at the forecast for the US, it doesn't look too bad on the face of it. The annual return for the next 10 years is expected to be just under 6% per year. If you compound that over a decade, that means it's a 74% return. If you invest $100, that'll turn into $174, which seems pretty good. However, if you look at stocks globally, excluding the US, the return's significantly higher. Now we're talking about 8.4% per year, which compounds to 124% over a decade. That's almost twice as much, and your $100 will now be turned into $224. So what's behind this outperformance? As we'll see, the US is still relatively overvalued compared to other countries. And because valuation is mean reverting, you'd expect the US to underperform as a result, as it reverts to its long-term average valuation. Another reason is that the US is typically very stingy when it comes to income, and that dividend yield will provide a boost to stocks in the rest of the world relative to the US. As US monetary policy has kind of led the way relative to the rest of the world, with the Fed hiking more aggressively and more rapidly than other central banks, that's made the US dollar strengthen hugely. Now, as things start to normalize and other interest rates start to equalize with those of the US, we'd expect the dollar perhaps to go into reverse. So that'll be a drag on the US relative to the rest of the world. The one thing which is in the US's favor, according to Vanguard, is that its earnings growth will be slightly higher than other regions. But taken as a whole, this is what results in the underperformance of the US relative to stocks elsewhere. Now let's turn to the evidence that US stocks are expensive. That might seem surprising given the size of the US stock sell-off over the course of 2022. But of course, valuation is always relative. And if we look at the forward price to earnings ratios across the world, so here we're taking the price of an index and we divide by the forecast earnings over the next year, you can see that the two countries which come out way on top are India, which has almost a 21 times forward price to earnings multiple, and the US, which is just under 19 times forward earnings. There's a very large gap between those two and the next most expensive country, which is France, Japan, Canada, and so on. Now, one consequence of being expensive is that it tends to reduce the long-term returns after that expensive point. And this is what's feeding into Vanguard's forecasts. If we take a much longer history of forward price to earnings ratio, and this is from Yardeni, and it goes all the way back to 1960, you can see that currently the US isn't particularly expensive. It certainly was after the Pandemania rally, and the sell-off has reduced its expensiveness, but it's still above what you might consider fair value if you look at that long-term average, which is something like a 15 times forward price to earnings multiple. So not super expensive, but not super cheap either, and probably still above fair value. Now, you might say that people are simply paying for US growth, because one thing the US is amazing at is growing its earnings. So how about if we look at a valuation measure that looks at that growth? So instead of dividing by the forecast 1 year ahead earnings, now we're going to divide by the 5-year forward forecast earnings. But by this measure as well, you can see that the US is commanding a significant premium, certainly compared to history. Now, partially that's because earnings growth has been revised downwards, and that's because very high inflation has eroded US margins, and we're expecting a soft patch in US growth. If instead of using forward earnings, we use trailing earnings, in other words, we look back in history to see what earnings actually were created, and here we're doing it over a decade, so it's a cyclical measure. This is the cyclically adjusted price to earnings ratio of Robert Shiller. What you can see here is the percentage of time each market has been cheaper. So if the number's big, that means the market's expensive. So the Netherlands comes out on top. It's been cheaper 90% of the time. India's been cheaper around 80%, and so has the US. So even on this measure, you can see that the US is still looking very expensive relative to other countries, with the exclusion of the Netherlands and India. Another headwind for the United States is that the US dollar is expensive. As we said, part of the reason behind that is the fact that US monetary policy got ahead of the rest of the world. And as a result, higher interest rates usually mean that the dollar will get stronger. That's certainly been the case recently. You can see there has been a bit of a fallback, but it seems that now, as inflation is surprising on the upside again, we're going back to that playbook of dollar strengthening relative to currencies in the rest of the world. Let's consider what that means from the point of view of US investors, and in particular we'll look at how it affects their holdings of non-US stocks. So let's say they hold Japanese stocks denominated in yen, European stocks denominated in euros, and UK stocks denominated in sterling. If, as many people expect, the dollar's about to weaken, then that means that we're going to be multiplying by a bigger number. So if we convert yen into dollars, euro into dollars, and sterling into dollars, we'll get more dollars. And that in turn means that those foreign investments, when put back into dollars, will be worth more. So during a period of dollar weakening, it makes sense for US investors to invest outside the US, because then the dollar depreciation will boost the value of their foreign investments. How about international investors who are outside the US? Well, the thing is, the US market is so big that if you have a globally diversified portfolio, and here's the allocation breakdown for a global equity index, the MSCI ACWI index, you can see that the US makes up a huge 60% of the stocks in that diversified portfolio. So in other words, dollar devaluation will have a big impact on those investors who are diversified globally outside the US because of the dominance of the US equity market. So let's consider from the point of view of those non-US investors who, not necessarily by choice, have a huge US stock exposure. What effect will dollar weakening have on them? Well, because they have so much money invested in dollars, we're now dividing by a bigger number when we convert back to their domestic currency. So if we convert back to sterling, for example, we'll get less sterling as the dollar weakens versus sterling. So for those investors, they'd rather avoid investing in dollar assets. But notice that this amounts to the same thing, which is that you'd avoid investing in the US stock market, whether you're a US investor or whether you're a non-US investor. If you enjoy our videos, you'll probably love being part of our community, and you get access to all kinds of goodies. A huge and growing library of explainers, which are for members only, access to Slack so you can discuss questions about investing anytime you like, and you get access to special trackers which give you a macroeconomic overview, but also valuation overviews like that CAPE ratio which we just saw. If you want to learn more about that, just click on the link beside me and in the description beneath me. Assuming there's a lost US decade, let's consider what UK investors can do to avoid it. First of all, let's think about currency. Now, what should the value of sterling versus the dollar be? There are various models which predict this. Purchasing power parity models, PPP models, are very widely used. And the forecast you can see here, the red line, is from the OECD. Notice that there are very long periods of time and huge swings away from the PPP estimate, but it does seem to converge back to that forecast. Now, currently the value of sterling as I make this video is 120 versus the dollar, and the PPP estimate is 148. So that would be a 19% weakening. In its outlook, Vanguard says it's closer to around 13%, but still that represents a substantial weakening of the dollar versus sterling. So what we're going to do is tweak our global equity allocation such that we dodge this bullet. Now, in order to do that, you probably don't want to have one fund per country. There would just be too many. So what I've done is I've broken down the MSCI ACWI index according to the region of each stock in the index. And as you can see, the US makes up 60%, Canada 3%, and so on down the list. Unfortunately, these regions map nicely onto individual funds. Now, what would be truly ideal is if we could get a global fund which simply excluded the US, but for some ridiculous reason, you can't buy those in the UK, which is why we have to go this way around it. So our first option is simply to hedge the currency exposure for the US. So what we do is we buy one fund for each of those regions, and I'm sorry, Canada, I've lumped you in with the US. I know you won't like that. So that's why the US is now 63% rather than 60. But notice that that exposure is sterling hedged. That's what this GBP hedged means. Now, there are other ETFs which you can buy which give you the same exposure, but I found that this one was one of the cheapest. The fee is only 0.05% despite the hedge. And you can see I've also tried to choose other funds which are very cheap, such that the overall fee for the portfolio is just 0.06%. So in other words, what you've done here is you've reproduced a global index, but you've sterling hedged the dollar exposure. So if the dollar does weaken, it's not going to affect your returns. Option number 2 is simply to reduce your US equity exposure. Instead of 60%, here I've got an example where I've reduced it by 20%, and then I've added Canada back in. So now the US, which includes Canada, makes up 45% of the portfolio. What's happened to all of that allocation? Well, I've simply redistributed it amongst the other funds, such that their relative proportions remain exactly the same. So these are the new weights based on that US underweight. So if the US does underperform relative to those other regions, now that won't be such a problem. Now, if you're on the Vanguard platform in the UK, as I am, then you can only buy their funds. So I've also shown here how you can tilt away from the US using Vanguard funds. So the weights are the same here on the right-hand side, but the fund mappings are different. And as a result, the fee's actually a bit higher because Vanguard isn't always the cheapest. Now let's think about things from the US investor point of view. Here's the actual breakdown of the sources of underperformance for the US relative to the rest of the world. So on the far left, you can see the forecast return of MSCI USA over the next decade, and that's 5.7%. And on the right, you can see the MSCI ACWI return, that's the All-Country World Index, global stocks, excluding the US, and that's 8.5%. Then in this kind of waterfall plot, you can see the differences between the two explained using 4 factors. 3 of the factors are positive for ex-US. One of those is valuation, because the US is more expensive, and we'd expect that valuation to normalize. Dividend yield gives another 1.4, and the foreign exchange return as the dollar weakens adds another 1.2%. And as we said, the US earnings growth is the thing which is in its favor. That's going to subtract 0.7% from the underperformance. But of course, the US is a huge and very varied market. So if you break it down into its subcomponents, there's actually quite a bit of variation amongst different types of US stock. The 10-year forecast, the central forecast, is this 50th percentile, which I've highlighted for each of these different slices of the US market. The one which really stands out for me is US small caps, which are expected to have a 6.1% return on average over the next 10 years. And that's considerably better than US equity as a whole, which is 5.7%. I think it's clearer if we put it as a bar plot, which you can see beside me here. You can see global ex-US equity is 8.4. That's considerably more than any of these subcomponents of the US market. But US small caps would be a tilt that would at least reduce some of that underperformance. US REITs are also pretty good at 5.9%, but the one which really underperforms because it's so egregiously overvalued still is US growth. That's only forecast to return 4.1% over the next decade. Now, fortunately for US investors, you have much more choice when it comes to funds, and you have lots of choices for international stocks. In other words, global funds excluding the US, and those tend to be very cheap as well. So all you have to do to avoid this underperformance is to tilt away from the US into so-called international stocks, which is what the US calls global ex-US funds. If you do want to stick to the US, another alternative is to tilt into one of those styles which won't underperform so much, like small caps, which look pretty reasonably priced right now. So it's a bit controversial to say that there's going to be a lost US decade, particularly as we've just come off a decade where the US has outperformed massively. But of course, that's the point. That's why the US is expensive relative to the rest of the world. And that is usually the precondition for a decade of underperformance relative to the rest of the world. Now, don't forget our offer. If you do want to learn more about investing as part of our friendly online community, then simply go to our website, PensionCraft.com, to learn more. And there'll be a link beside me so that you can learn more about that. And there'll be one in the description as well. And as always, thank you for listening.